ළමයි good morning ඇහෙනවද සමිදු?
Good morning, sir.
ඔව් ළමයි පොඩි ප්‍රශ්නයක් තියෙනවා මේ උදේ ඉඳලම කරන්ට් එක නැහැ. මම මේ hotspot වලින් යන්නේ. කොහොමද ඔයගොල්ලන්ගේ පැති වල කරන්ට් එක තියෙනවද? මොකක් හරි issue එකක් තියෙනවද? නැත්නම් අපේ විතරද?
තාමනම් මෙහෙට තියෙනවා සර්.
මේ මම ඉලෙක්ට්‍රිසිටි බෝඩ් එකට කම්ප්ලේන්ට් එකකුත් දාලා තියෙනවා මේ ගොඩක් මේ අර ෆ්ලක්චුවේෂන් එකකින් පස්සේ ගියේ. තාම ප්‍රොසෙස් කරනවා කියලා තියෙනවා. හරි අවුලක් නැහැ. දැන් අපි සිලබස් එක ඔක්කොම කවර් කරලා තියෙන්නේ. ඒක නිසා මම අද මේ ඔයගොල්ලොත් එක්ක මේ YouTube එකේ link එකක් තමයි බලන්නේ. හදිසියක්වත් ඒක නැවතුන තින් මම link එක දෙන්නම් වෙන. තාම මේකේ තියෙන්නේ මේ processing කියලා තියෙන්නේ 8:40ට. තාම ඉලෙක්ට්‍රිසිටි බෝඩ් එකේ මොකක්ද ලොකු ප්‍රශ්නයක් හදාගන්න බෑ බලමු. මේ ඉතින් මොකද්ද මම කියන්න හැදුවේ? මොකද රටේ තත්ත්වය? ඔය පැත්තේ මොනවද කරදරයක් නැද්ද ඔයගලන්ට? හ්ම්? මම කොහොමද කචල් එහෙම කියලා ඉවරලා? දේශපාලන ප්‍රශ්න. ඇහෙනවද ඔයගලන්ට? Amasha, can you hear me?
Yes, sir.
Any issues of your area? මොනවාරි ඔයගලන්ගේ පැති වල මොනවාරි ප්‍රශ්න තියෙනවද ඔයගොල්ලෝ? ඔයගලන්ගේ යාළුවන්ට එහෙම මොනවත් එහෙම කරදරයක් නැහැ නේ?
එහෙමනම් නෑ සර්. මේ පැත්ත නම් එච්චර ලොකුවට ගිහින් නැහැ.
හරි. අපි ඒ ගැන කතා නොකරමු. මොකද මේ ලෙක්චර් එක රෙකෝඩ් වෙන නිසා. ඕකේ. අපි දැන් මේක මම මේක ප්ලේ කරනවා. ප්ලේ කරලා ඉවරලා ඔයගොල්ලෝ මේක බලන්න. බලලා අපි මොන හරි ප්‍රශ්න තියෙනවා නම් ලෙක්චර් එකෙන් පස්සේ ආයෙ කතා කරමු. නැත්නම් අපිට තව මොන හරි තියෙනවා නම් අපි තාම මගේ මේ මොකද හේතුව පේපර් එක මොඩරේට් වෙලා ආවේ නැහැ හිලරි සර්ගෙන්. ඒක ආව නම් මට ඔයගොල්ලොත් එක්ක ඩිස්කස් කරන්න තිබ්බා මේ ටොපික්ස් ටික. ඒක මම බැලුවා. අපිට කරදර කරන්න බෑනේ. ඒක නිසා අද ඔයගොල්ලන්ගේ ඔක්කොම සිලබස් එක මම කවර් කරලා තියෙනවා. So let's watch this. After that we'll have a discussion if required. Okay. මේක ඇහෙනවද කියලා පොඩ්ඩක් බලන්න. Message එකක් දාන්න ඇහෙනවනේ.
Welcome, everybody. Thanks for attending this session. I'm one of the three chairmen of the special interest group of the European Law Institute on Business and Financial Law.
Okay, let's watch this.
We started last September a project at the SIG level concerning corporate sustainability, which is a special focus on financial accounting and share capital maintenance. And so we have been working with the team on two reports, one gathering empirical evidence and one reviewing the regulatory context, especially at the European level on these matters. And all the members of this panel kindly accepted to participate, but they are also contributing to our project, either as a member of the research team or as member of the advisory board. So I welcome everybody. Thanks for accepting our invitation. I will leave the floor to Corrado, which will introduce the speakers and keep the timing. And I will also, at the end, convene our conversation and gathering your question and answer together with Corrado. So welcome.
Thank you very much, Yuri. A warm welcome to all the participants and also to our panelists. The panel is named Corporate Sustainability, Financial Accounting and Share Capital. And as Yuri was saying, it will build up on the project the special interest group is preparing. I won't take much time. I just give a short introduction of the speakers this evening. I just remind you that you can write your questions in Zoom, and that we will have a Q&A session at the end. First speaker will be Colin Aslam, who is Professor of Accounting and Finance at Queen Mary University in London. Then we will have Maria Di Sarli, who is assistant professor at the University of Turin, and a member of the board of directors of the Center on Regulation, Ethics and Society in Turin. Third speaker would be Vera Palea, who is associate professor in accounting and finance at University of Turin in Italy. And finally, we will have Jean-Philippe Robet, who is a practitioner based in Paris of an important US law firm, but more importantly, is author of several important publications on the sustainability and in company law debate. He lectures at Sciences Po, and he is a member of the informal group of company law expert at the European Commission. So I think we can start immediately by giving the floor to Colin Aslam, who will introduce us to the project that the Special Interest Group is developing.
Hi, could the host enable screen sharing, thanks. Okay, thank you. Okay, so I'm going to present an overview of the project from the sort of financial analyst sort of point of view and relate that to work that's ongoing within the European Commission at the moment. So at the moment, the European Commission is concerned with short-termism and its relationship into corporate governance and the behavior of companies. And this project has looked at the evolution of the amount of net corporate funds or net profits that are being paid out to shareholders in the form of dividends and share buybacks. And this behavior, it's argued, crowds out the use of financial resources for the creation of value over the lifetime and the life cycle of the firm. For example, it's crowding out investment in infrastructure, training, research and development, and investments in sustainability. So on the one hand, we have the European Commission report just out, and the prescription within that report is to lengthen the time horizon in corporate decision-making and promote corporate governance that's more conducive to sustainability. Okay, so the report that we've produced for the ELI, Company Capital Management, Safeguarding Financial Resilience for Corporate Sustainability, focuses in a similar way on how a large group of European companies have become financialized and how this process threatens company solvency and the maintenance of going concerns. And there are sort of two key issues that we draw out in this report. Similar to the European Commission study, we look at corporate distributions in terms of dividends and share buybacks, which is a form of asset value extraction for shareholders. But our argument in the report is that this can also undermine the accumulation of shareholder equity funds. And these funds are an important loss absorbing and resilience buffer. And on top of that sort of behavior in terms of governance, we also have a constellation of accounting regulations that are promoting a shareholder value project, and specifically around the use of fair value accounting for investors. So the prescription from our report is one of encouraging company law and accounting reforms to promote company financial resilience, solvency for a going concern. So the first issue I want to really bring to the fore is corporate financial sustainability and the issues that we draw out in the report around this theme. What we've found in the analysis in the report is a significantly large group of European companies are aggressively distributing net income in the form of dividends and share buybacks. And this is eroding their shareholder equity reserves, which are a loss-absorbing buffer. We also observe that fair value accounting is further exposing companies to speculative asset valuation risks. And this is because asset value impairments would need to be charged against shareholder equity funds if those asset values are deemed to be impaired. So we have a combination of processes taking place. First of all, a hollowing out of equity reserves because of high dividend distributions and share buybacks. And on the asset side in balance sheets, an increasing fair value asset impairment risk, which has the potential to undermine financial sustainability and solvency in a significant number of large European companies. So the purpose of our report, I think, is similar in many ways to that produced by the European Commission, but different also in a number of ways. And the report is trying to tilt the balance of corporate governance towards financial resilience. So as I see it, our report for the ELI calls for evaluation and action from the regulatory networks governing company law and accounting disclosure practices. Our report challenges company law regulators to reinstate a prudential maintenance of shareholder equity reserves, not only for creditor protection, but more generally for solvency and securing financial resilience. And our report also challenges the accounting profession and its governing regulatory network to reconsider the implications of adopting fair value accounting, specifically stress testing the impact that impairments to speculative asset valuations might have on company financial viability. So we all know that COVID-19 will seriously challenge the resilience of our healthcare systems in Europe, and it is doing so as I speak. And it will also challenge economic stability if full or partial lockdowns continue. For a large number of European companies, hollowed out shareholder reserves will not only need to absorb lost earnings as demand falls, but these negative earnings can lead to a triggering of impairments to speculative asset valuations, amplifying corporate downsizing and liquidations. So looking to the future, the lessons that will arise out of the emergent economic sort of crisis mustn't be wasted. The challenge for regulatory networks governing company law and accounting practice will be to help anticipate and weave financial resilience into the fabric of corporate governance. Thank you.
Thank you very much, Colin, for introducing the topic. I give the floor now to Maria Di Sarli. In the project, we expect to have national reports on the rules governing these issues related to accounting and share capital in light of the goal of sustainability. And Maria will present to us the Italian case. Please, Maria.
Okay. Good evening, everybody. Thank you very much for inviting me to this panel. I'm really pleased to be here. In a short summary, my participation primarily focused on the risk of distributing not realized profits deriving from the application of international accounting principles, and secondly, on the Italian solution to mitigate such risk. As it is known, in the traditional European accounting approach, there was a close bond between financial statements and the determination of distributable profit, as this organizational purpose was being prosecuted through some accounting rules, in the sense that this outcome was usually already pursued during the preparation of financial statements through compliance with the prudence principles and other principles related to revenue realization and participation of losses. On the basis of this set of principles, as all we know, the key evaluation criterion was the historical cost. In Italy, as in some other countries, European countries, this traditional accounting approach is no longer used following the introduction of the international accounting principles, and that both in two ways, directly and indirectly. Directly, as the Italian lawmaker has extended the international accounting principles also to the annual accounts of certain categories of companies. Indirectly, as European institutions, in order to render financial statements compliant with the international accounting principles, more comparable with those drawn up in compliance with the European accounting directives, has introduced some IFRS rules, for example, fair value evaluation for some items in the European accounting systems. So, what is the point now? The international accounting principles give the financial statements a primarily informative function, in the sense that they not include the prudential measurement of distributable profit among their objectives. They are aimed at representing the actual value of equity and the overall performance for a certain period, including income components which have not yet been realized, but which merely derive from changes in the value of the net of the asset, some asset included in the company's equity. In this sense, the application of IFRS principle, as they imply the substantial supersession of the realization principles, renders the financial statements compliant with them not fully suitable for the determination of distributable profits. So, next slide, please. So, what is the problem? No. What's happened? In the absence of harmonized European rules, different approaches have been followed by the various European member states to avoid the risk to distribute unrealized profit, and what consequences, which possible arbitrage risk. Maybe the next slide. Okay, thank you. The presence, in fact, the presence of different rules are likely to create two problems. Disharmonies within European member states regarding the level of protection of creditors, which in the light of the freedom establishment granted to European companies could trigger competition among European legislative frameworks. Second, inconsistency within the same legislative framework, and consequently speculative opportunities in the choice between international accounting principles and national accounting rules is for example, the Italian case. So now let's see the Italian solution and the next slide to avoid the risk to distribute not realized profit. So the Italian lawmaker has introduced a corrective system inside the company law. In few words, the goal of not distributing unrealized profits have been moved from the preparation of the financial statement to the moment of the calculation of the distributable amount of the profits. In this way, annual IFRS accounts represent only the starting point for the determination of the distributable amount. In short, the method consists of two steps. By means of off-balance sheet operation, the most relevant not realized profits are eliminated from the financial result. These elements are neutralized by allocating their value in non-distributable reserves. With regard to these reserves, next slides can show. With regard to these reserves, the Italian law states they are not allowed to dividend distribution, free share capital increase, and buyback. Please also note that anyway listed companies which are IFRS adopter are not allowed to buy back more than 20% of their nominal shares. It's another interesting point of our system. So, last slide. What are the advantages of the Italian system? It has a prudential approach in order to limit the risk of capital repayment to shareholders. It allows to remove not all, but most of the relevant unrealized profits from the financial result, and it does not require the drafting of two sets of financial statements, so it can save administrative costs, and it avoids the misleading effects coming from the drafting of two different financial statements. Now, the point is that it's clear that it's necessary an harmonization of these issues. And in my opinion, the Italian method could be a good model to follow. Thank you for your attention.
Thank you very much to Maria Di Sarli. Now I give the floor to Vera Palea. She will provide us with a more European perspective of accounting regulation on this broader issue. Thank you very much.
Okay, thank you, Corrado. Thank you very much for giving me the floor. And thank you very much for the invitation. My presentation will focus on some critical issues about IFRS adoption in the European Union, which we came through during our research, and which I believe it makes cooperation between economists and jurists particularly desirable and fruitful. What we see from our analysis is that IFRS adoption, with fair value as the main measurement system, can significantly endanger the stability of firms and the resilience to economic shocks. Colin has provided very helpful evidence about that. IFRS have been adopted for listed companies in the European Union starting from 2005 by means of a European regulation, whereas the European directives on accounts still apply to non-listed companies and sets historical cost accounting as a basic criterion. Historical cost is a very prudent criterion which requires an asset to be on the balance sheet at its historical cost, even if it has significantly increased in value over time. In contrast, fair value accounting is speculative and uncertain in nature, as it is calculated as the present value of a future stream of unrealized income. These two very different criteria correspond to different purposes assigned to financial reporting. According to the ISB, financial reporting is for equity investors. In contrast, under the European directive, which were inspired by German accounting tradition, the focus is on all the stakeholders and prudence is a key criterion. Prudent information reassures creditors that there are realized revenue and collateral to support their loans, and reassures employees that the firm is solvent and stable over time. According to IFRS regulation, to be adopted in the European Union, IFRS must meet the requirement of a true and fair view as laid out by the European directives. This requirement is detailed in the directives in a number of rules, among which prudence, again, is the most important. Furthermore, the standard, the IFRS, to be adopted, to be endorsed in the European Union must not endanger financial stability and sustainable economy. And now I come to the point. The European Court of Justice has remarked that accounts are not only of importance to shareholders, but also for the protection of third parties, since enterprises offer no safeguards beyond the amounts of their net assets. For this reason, the court has affirmed that fair value accounting is inconsistent with the prudent criterion that accounting needs to comply with. In other words, limited liability calls for historical cost. In this respect, my legal concerns are the following. What is the legal consequence of the European Court of Justice judgment on IFRS adoption in the European Union? Is the IFRS regulation no more applicable following this judgment? What should be done and how can it be extended from a single case examination to the IFRS regulation taken as a whole? Another interesting point refers to the relationship between IFRS regulation and the Lisbon Treaty, which represents the institutional setting of the European Union. The Lisbon Treaty sets sustainable development as a core value of the European Union, Article 3 of the treaty. Economic academic research has widely provided compelling evidence that compared to historical cost accounting, fair value accounting can significantly harm sustainable development and financial stability. Well-established literature shows that fair value accounting played an important role in amplifying market turmoil and financial instability during the global financial crisis. A stable financial system is fundamental to retool the economic according to environmental and social sustainability criteria, which are core to the Lisbon Treaty. This is even more important in post-COVID times, in which firms have accumulated huge income losses due to the lockdowns and needs stable funding for green investments. Luckily, the European Commission has become aware of this issue, considering for the first time possible revision of fair value accounting for long-term equity investment. Further concerns are therefore the following. If the Lisbon Treaty ranks higher than IFRS regulation, what should be the practical implication of the inconsistency between the two, which the economic analysis points out? Again, what should be done and what should be proposed in order to reaffirm the right order in legal ranking and to protect the fundamental values of the European Union? Based on evidence, on economic evidence, I was wondering whether a precautionary criterion could be invoked to suspend IFRS regulation. I'm referring to the precautionary principle detailed in the European Union, which allows the European Union to adopt urgent action whenever given policy, accounting regulation in this case, can harm the public or the environment. To conclude, as never before, the urgent questions posed by sustainability, among which climate change, environmental degradation, and related healthcare risks, including the COVID-19 pandemic, stand out, require a consistent accounting framework which must not endanger the fundamental objectives of sustainable development and financial stability set out by the treaty. This being the issue at stake, I would like to conclude by reiterating that only a truly interdisciplinary approach, a convivium of accounting, economics, and law expertise, to say in Europe beyond these words, could be particularly fruitful in addressing and solving the question raised before, and to enable society to advance toward a more sustainable future. Thank you very much for your attention.
Thank you very much to Vera Palea. Now I give the floor to Jean-Philippe Robet, who will give us his impression on this project, on the role of financial accounting in the company sustainability debate, if any, I would say. Thank you.
Thank you, Corrado. Thank you for giving me the opportunity to take the floor today. I first would like to thank all the participants to be with us tonight, but also the presentations we got so far, which have been very impressive, and I have learned a lot. It's funny because when you think, you know, the people at large in society think about corporate law and accounting, I think these are the two most boring topics they can think about. It seems to be technical, you know, something which does not require a lot of creativity and which really falls from the rules of nature, you know, nothing more than that. Actually, what we are witnessing today, and we have been witnessing for many years now, is the fact that a very strong ideological fight has been going on around the conduct of the economy, and it has been translating into rules of corporate law and rules of accounting. Let me explain what I mean by that. As we all know, you know, limited liability corporations have been invented in the 19th century. There were some issues earlier, I mean, some cases earlier, but really it took off in the second third of the 19th century. And at the time, the big thing was, well, you know, to be able to have these corporations, it is necessary to have limited liability. But limited liability was a big issue in a liberal society. So the whole architecture of the limited liability company is that the shareholders are only the owners of the shares issued by the company. They are not decision makers. They are not the owners of the corporation. They are not the owners of the firm. Of course, because they invest their capital on the primary market for companies to be able to develop projects, they are bearing risks. So they need to have the ability to check what is being done with the money they have invested, but they have no direct management power. And the managers, on the other hand, are not managing their own money. They are managing the money which is owned by a legal institution, a corporation, which is not the thing, the object of the shareholders. I'm going back to these basic principles because it has consequences for accounting. If you take that historical view, you know, you want to make sure that those who are managing the money are acting without taking too many risks because there's limited liability. You want to make sure that they take into account the interest of the shareholders because otherwise they will not be compensated for their contribution. But you want to make sure that when money is returned to the shareholder under the form of profits, it does correspond to some form of value creation. Also, because you have this new vehicle in the legal system and economic system, you want to make sure that all sorts of interests which can be affected are taken into account in the drafting of the accounts. And the people who are supposed to be the beneficiaries of the drafting of these accounts are not only shareholders. There are a whole set of parties, of course, lenders, of course, salaried employees, but also the environment, even the tax administration, etc. You have all sorts of interests which are somehow taken into account. Maybe not enough, and in today's environment, it should go beyond, but that's where we come from. And then what happened? We had the agency theory guys stepping into this whole thing and say, well, let's disregard the law. You know, this is technical. You know, the reality, frankly, is that shareholders own companies, they own firms. This is their stuff, and the whole thing is managed in their sole interest. So, you know, these prudential accounting rules, which makes that we cannot get money back unless all these, you know, rules are being followed. You know, let's draw the accounts differently. You know, let's look at financial reality. You know, the past is not important; it's dead. What matters is the future. Even the present is not important. The present is dead as we speak. So only the future matters, and therefore we have to look at this fantastic creation, not from the point of view of risk, etc., but from the point of view of the owners of the damn thing, okay, of the companies, firms, etc. And therefore, the beneficiaries of the account should only be shareholders. And we should maximize the value in corporate governance, and we should find ways to increase what can be distributed to shareholders. And what the specialists we had tonight explaining, you know, to us in very detailed ways and very, very interesting ways are simply the outcome today of what is happening to us in accounting, in corporate law, in financing, understanding of how this should be structured. And we are all somehow the victim of an ideological construction which does not correspond to the legal construction at all. Now, which one should prevail? Of course, classical economists consider that, you know, the financial view of things is the economic truth. The rest is petty technicalities invented by the lawyers. But what the lawyers have been creating over the years, decades, now centuries, in connection with this specific legal instrument of the corporation, is trying to preserve a lot of varied interests. And and I do think in this regard, the lawyer's construction as a coherence, which corresponds much more to present day problems than the view of the economist. Because we know that the present economic system is generating a lot of negative externalities, okay, which of course are not taken into account. They appear nowhere in the accounts. And at a time when we face extraordinary environmental challenges, you know, beyond, of course, financial sustainability, which is important. And Colleen, I understand what you said, and I think, I'm totally in line, of course, with what you said, but it goes even beyond that. You know, financial sustainability look at the preservation of financial capital, but environmental capital, human capital are also forms of capital which are being affected by corporate governance, by corporate accounting. And I know the technical problems this leads to, but this is what we should be addressing today. How can we have accounts which give a truer value of the real value creation by firms, which goes way beyond pure shareholder value. So I leave it at that. Sorry about this mistake. And I think maybe we should take some few Q&As.
Thank you very much. Jean-Philippe Aubé, please, Yuri.
Yes, sure. So I will respond to the first query, which was about the future of corporate governance, by resuming what we have been discussing. I think that's the main, we all share this idea that we spent these 2 decades in this ideological setting, which also have partly intended and partly unintended consequences. So they really wanted to empower, to make shareholder more wealthy, and it was intended consequences of agency theory and its application, and also its use in the lawmaking and regulatory making environment, because it's much more contested at the academic level than actually in the regulatory sector until 10 or 15 years ago. We hope, we have been working also to move this situation into a new present. So for instance, we started our project, we started discussing 2 years ago, and 1 year ago we launched it officially. And now actually the report, the companion studies by the European Commission are still taking some points which we are making, and also moving, getting in similar evidence about the short-termism and the effect, actually the unintended effect of such a move toward empowering and making just a shareholder more wealthy through company law and corporate governance. And of course, the financial accounting dimension is neglected there because it's just a mere technicality. And so I'm really glad that Maria has pointed out that this kind of connection between company law and corporate governance and the financial dimension is still considered by some lawmakers, and so it's still part of our legal environment in Europe. And so we want to draw upon this consideration, this understanding, because perhaps after these 2 decades of ideological setting, we also need to refresh our mind by looking back and looking around and see that not everything has moved there, even if our thinking is keep ignoring it because we are blinded by this ideology. So, and Vera stresses a very interesting point about the policy inconsistency of the current situation. So even at the European level, we have in between the two, we have still a regulation which strictly try to enforce the primacy orientation, and we have even other units in the European community, European institutions, which try to say what sustainable corporate governance should be. So this is a very important debate, I think. So what we try to say that and Jean-Philippe, you're right. We point quite surprisingly on financial sustainability, but the assumption was that only financially sustainable companies can take care of more broader concern. If they are financially fragile, of course, they are under threat of being default or going even under distress or even being liquidated. And anyway, they will devote most of their resources to something else, to pay out someone else. So they will not be able to take care of social, stakeholder, or environmental concern. In some cases, environmental risk can be major, and so we wanted to focus on this financial aspect to see that the company is still an economic unit. So we need to move from this economic financial dimension to add to this, not just put in parallel, because this is the current risk with no financial reporting and sustainability of corporate governance. So I want to conclude this long talk with the last point, because the prescription by the European Commission report, which I just for share at this stage, are about giving you director more duties and more obligation. But this, even the good faith directors, I don't want to assume, it will not be fair or true to assume that all directors are corrupted, and crony. Let's assume that a good faith director wants to do something, but his decision is in a board. He cannot take decision in a vacuum. So if we don't give him sufficient argument through proper reporting and sufficient also framework support, facilitation by the regulatory framework, he will not be able to challenge the current situation, will not be able to take decision different from this kind of orientation, which has been the social norm for so long. So I think we really need to work on the European law and regulation on company law and financial accounting, because this is our focus, but also, of course, corporate governance and other fields, merger and acquisition. So you have other kind of issue which perhaps we cannot cover, but we can still think about in order to make possible for those directors to take different kind of decisions, so more sustainable ones, so to keep sustainability in mind. Because otherwise it would become just an appeal to their ethical underpinning, let's see. But they also need something much more practical, like having good numbers about the economic impact of this risk. So if they can say, look, in the next 10 years, we will be confronted to future charges for environmental action plans, which we want to do. So we need to have money to take resource apart to pay for these actions plans. So this is essentially the basic idea we want to work out, of course. After the rest is technicalities, but I think it's very important also to point to what we have in mind. And so our discussion was very effective, I think, to show some legislator has been thinking about how financial economists could have a look and suggest evidence, issues, and also solution, how the regulatory framework in Europe by Vera can respond to this, and also your view, which is also the core of the project, about the company law dimension. So where we move from and where we end up for a while, which was quite long, and now we could move from it to go beyond and come back, in a sense, to some idea of a firm as a going concern, so more sustainable for all stakeholders, including shareholders. So thank you.
Yuri, I don't know if we can comment, but I would just like to say that if I were a director at a listed company today, I would be very worried, because I know that my duty as a director is to give to the public, whatever that means, a true and fair view of the outcome of the corporation's activities. And today, the accounts do not do that. And I think directors who do nothing about this are taking a very, very big risk.
I definitely agree with you, but I've been surprised by the fact the accounting profession doesn't seem so concerned about this kind of legal and professional risk, because they're not only legal. Okay, in US they are also legal, but in a sense, even in Germany, actually, they have been doing lawsuits about company law and using accounting as a background. So, but sure, but it's also reputational risk, and so every kind of scandal occurred, of course, accounting is always under the criticism. So I always have been surprised by this aspect. I've been trying to raise the point when we discussed the fair value regulation, and we will definitely raise this issue when we talk about sustainability. But yes, it's perhaps that ideological move was really blinding people. You know, this is strange social effect in a sense, but let's try keep things has been moving. So let's hope that we can also have a contribution on opening their eyes in a sense. But I don't want to monopolize the floor, so please, because we don't have other queries, so we can definitely go on discussing for a few minutes. So if you want, I can raise questions to you if you prefer, or if you have points just to react to each other presentations. It's really open to us. Otherwise, we can have a look around. So for Colin, I will ask him if he can say a bit more about the evidence he has collected. So if you can a few words about the empirical evidence we have been gathering for the project, so people can have an interest in knowing more after we will eventually publish it. And for Maria, I think it was very clear how, so the most interesting point now is the implication. If you can say more about this policy inconsistency that you can find within the same country and between the European countries, because of course this is a really matter of EU law. And for Vera, I think that you pointed out this policy inconsistency at the very top level, not at the country, let's say transnational and national level. But it would be probably interesting to insist on why this is so important to come back to the treaty, you know, and to the hierarchy of law you have mentioned it, in the sense of how we could have a better Euro law and regulation on these matters. So yeah, this would be my first query, just to have you clarifying your point, so you have another occasion to complete your presentations.
Keeping in mind we have just 5 minutes left.
Yeah, I have 10 minutes left in my clock, so just take it very briefly. Thank you.
Okay, so I'll just respond briefly. I think that what we found from the analytics really is that an increasing number of companies over time are distributing more of their net income as dividends, and particularly now share buybacks, with share buybacks becoming an increasing component for various reasons. And in addition to that, we also find that companies are increasingly adjusting their balance sheet assets to fair value, depending on their business model. Property, for example, real estate investment trusts, or pharma companies, biological assets. And on top of that, they're all actively, aggressively pursuing M&A deals, and this absorbs fair value goodwill onto the balance sheet as well. So different types of asset classes are now being marked to market, and an increasing risk that those assets could be marked down in times when cash earnings are deteriorating, as we might find over the next few months. And that means that there's a very large adjustment in asset values, has to be written through the income statement and into the balance sheet. So our recent work, updating the work that we've already done, suggests that a 20% reduction in goodwill alone would wipe out 60% of net income across the whole of the Euro Stoxx 600. And also then would also severely damage the balance sheets in terms of solvency of around 25% of companies listed in the Euro Stoxx 600. So there's a major, confluence of events taking place. The distribution, hollowing out equity reserves, which are an important buffer, and the shift to the fair valuation of different asset classes with different risk characteristics. Property, biological assets, financial instruments, goodwill, intangible assets, brands, licenses, patents, and so on.
Thank you, Colin. Maria, we will follow the order of the previous presentation.
We also have a question from the audience.
Sure, yes.
Okay.
I won't be directly concerned because it's about France.
About the inconsistency around the European member states, no?
Yeah.
But with regard for example, for French companies in France, is not allowed to use accounting principle for the annual financial statements. So the problem it was solved in this way. No? But in the German system, I know well, the companies have to draw up two sets of financial statements. One set with the informative function, and another one with organizational function. In Italy and in UK, the annual financial statements is compliant with the IFRS accounting principles for certain categories of companies, and the lawmaker has introduced a corrective system in parallel with the accounting law. So what I know.
Okay, thank you. And Vera?
Sorry, I'm unmuting. Okay, thank you very much. What I would like just to add for the public, for the jurists which are following with this our panel, is that it's very important to underline that accounting is not just a metric, but it's a calculative practice that shapes social and economic processes. Because in the end, financial reporting affects a great variety of constituencies, not only market actors as firms, investors, bankers, and auditors, but also ordinary citizens, employees, and state, as financial service information serves as a basis for determining several rights. It serves, for instance, to set the limits to distributable profits, but also to elaborate public budget, on which also some very important and key services as healthcare system relies on. So to say that we need to work on financial regulation, because financial regulation, again, is a very calculative practice that can shape the social and economic processes. This is just my main point that I would like to deliver to this.
Jean-Philippe, I wish you to say the last word. We received a question about the French law governing sustainability. Perhaps you could say a word about this, but also if you have a last word about our discussion and what we look forward to work together on corporate sustainability.
Well, first of all, I think this working group is right on, on topic. These are very, very significant issues today, and they need to be addressed. And we have a variety of point of views here, which is, I think, a good sign for the future. In France, what is interesting is that a few years ago or so, the Loi Pacte has been adopted. It's a very complex statute with many, many different provisions, but one of them is quite interesting. It's an introduction is the French civil code. And as you know, the civil code is something, of a very high stature in our legal system. And it actually added the second paragraph to Article 1833 of the French Civil Code, which provides that the company, and that's not corporations only, it's also partnership, whatever type of company. So that's several millions legal entities in France. The company has to be managed in its corporate interest, which sort of implicitly means it's not only the shareholders' interest, so the corporate interest, the company's interest, while taking into account the environmental and social impact of the decisions made. It doesn't sound like much like this, but it's a big change. It can lead to a lot of consequences which have yet to materialize, because courts, lawyers, courts have to use this text. It has to inspire other texts, other, more technical provisions. But I think it's an interesting sign that, at least in France, and at least at that point in time, there's an understanding that the management of companies has to go way beyond, making purely financial profits, and many other interests have to be taken into account in the management.
Thank you. Corrado, I think we are just out of time, so
Yes.
it's time to conclude.
I will close then, if you...
Please. Yes.
I will close then the panel. I will thank first the speakers, then the participants.
තමයි මට තාමත් මේ කරන්ට් එක නෑ ඒක ඇතින් ප්‍රශ්නේ. තාම ඔයගලගේ මේ ක්වෙස්චන් පේපර් එක තාම මේ කවුද හිලරිස මට තාම මේ මොඩරේට් කරලා දුන්නේ නැහැ. ඒක නිසා මට මොනවද ඔයගලන්ට කියන්න බෑ මේ මොන ඒරියාස්ද චෙක් වෙන්නේ කියලා. කෙසේ හෝ ඒවා තව අපිට කල් තියෙනවානේ. අපි ඒ ගැන එක්ස්ට්‍රා සෙෂන් එකක් දාලා හරි අපි ඩිස්කස් කරමු ඒ ගැන බය වෙන්න එපා. අනිත් එක තාම ඔව් මොකක්ද පුතා?
සර් ප්‍රසන්ටේෂන් ටිකේ ටයිම් ටික සර්ට කතා කරන්න කිව්වා.
ඔව් ඒක අපි ඔන්ලයින් කරමුනේ ලේසියිනේ. ඒ තියෙන තත්ත්වෙත් එක්ක.
සර් ඒතකොට සිකුරාදා තියෙන්නේ ප්‍රසන්ටේෂන්?
නෑ අපි දවසක් දාගමු. දවසක් දාලා විනාඩි 10නේ ඔය group 6යි නේද ඔයගලගේ තියෙන්නේ?
ගෲප් ඔව් සර්. හතරයි.
හතරයි ඉතින්. ඒකලා හැප්පි වෙන්න මේ මොකද මම කියන්නේ හැදුවේ තාම තීරණයක් නැහැ පුතාලා මේ එක්සෑම් එක ඔන්ලයින් තියනවාද කොහොමද කියලා ඉවරලා නැහැ. මොකද මේ සෙකන්ඩ් ඉයර් ස්ටුඩන්ට්ස්ලාත් එක්ක ලොකු මීටින් එකක් තිබ්බා. ඒගොල්ලෝගේ ගොඩක් ඩිස්ඇග්‍රීමන්ට්ස් තිබ්බා. ඒක නිසා තාම තීරණයක් කරන්නේ නැහැ. ඒගොල්ලෝ කොහොමත් යුනිවර්සිටි ඔතොරිටි එකත් එක්ක ඩිස්කෂන් එකක් යනවා කියලා ඉවරලා තියෙනවා. බලමු තාම දැන් යුනිවර්සිටි එක තාම ඔන්ලයින් නැහැ. ලබන අඟහරුවාදී නම් මේ ෆිසිකල් තියෙනවා කියලා තියෙනවා. තාම ඒ ගැන තීරණයකුත් නැහැ තාම. ඒ නිසා අපි බලමු මේක මේ ඕපන් බුක් එක්සෑම් එකද ක්ලෝස් බුක් එක්සෑම් එකද කොහොමද දන්නේ. දැන් අපි ප්‍රශ්න පත්‍ර හදලා තියෙන්නේ මේ මුලින්ම මම හැදුවේ ඕපන් බුක් එක්සෑම්ස් වල. ඊට පස්සේ ක්ලෝස් බුක් එක්සෑම්ස් කරන්න කියලා කිව්වා. ඉතින් තාම මොනවද ඒ ගැන තීරණයකුත් නැහැ. කලබල වෙන්න අවශ්‍යත් නැහැ. අසයින්මන්ට් එක හොඳට කරගන්න. එතකොට කොහොමත් මගේ සබ්ජෙක්ට් එක පාස්නේ. මගේ සබ්ජෙක්ට් එක ෆේල් වෙන්නේ නැහැ නේ කවුරුත්. එකම දේ ඒකනේ. මොන හරි ඕන දෙයක් තියෙනවා නම් මගේ නම්බරේ තියෙනවානේ. ඕන කෙනෙක් මට කෝල් කරන්න. 20 වෙනිදා වෙනකොට assignments ටික එවන්න. කම්පියුටරේ අන්තිම තැන තියෙන්නේ. මම මේ කරන්ට් එක ආවට පස්සේ මේ කම්පියුටරේ charge කරගෙන ෆයිල් එකම අප්ලෝඩ් කරන්න. ඕකේ දැන් අපි ළමයි
මේ ශාන් සර්ට කතා කරන්න කිව්වා අර රෙකෝඩින් ප්‍රශ්නෙට පොඩ්ඩක් සර්ට බලන්න පුළුවන්ද? ඒ කියන්නේ සර් මේ ශාන් සර් කිව්වා මේ රෙකෝඩින් ටික සර්ට එවලා හරි මේ සර්ට අප්ලෝඩ් කරන්න හරි මොකක් හරි එහෙම කතාවක්
නෑ ඒක මම කෙලින්ම මේ මට යාට උදව් කරන්න කියන්නේ මම කාගේද මේ ධනුෂ්කලගේ ටෙලිෆෝන් නම්බර් සරවම ඔක්කොම ෂෙයා කරලා තියෙනවා. ඒක අපි බලමු මම කතා කරලා බලන්න.
අසයින්මන්ට් එකක් තාම දුන්නේ නැහැ සර්.
හරි. මම පොඩ්ඩක් ශාන් එක්ක කතා කරලා බලන්න.
හරි.